Hello, ladies and gentlemen. My name is Greg Michalowski from forexlive.com, and today's date is April 29th, 2015. I'm going to talk here today at the FX Street webinar on trading what you see. Just to give you an update here, some economic data coming out just now, and we're seeing the consumer confidence come out weaker than expected at 95.2 versus 101.4 revised last month. The estimate was 102. Richmond Fed manufacturing index also comes in a little bit weaker at -3 versus -2 expectations. That is better than -8 last month. So we're continuing to see some weakish data come out. That's the fundamentals, but that's not what we see. So I'm going to talk about a little bit about what we see and how it's so important in your trading here today. First, before we get started, let me remind everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, and your risk tolerance. You can lose all or part of your risk capital. So what I like to say is be aware and be prepared. First off, for those who do not know me, my name is Greg Michalowski. I've been working in the financial markets now for 28 years. 15 years we're on the institutional side of the market as an interest rate derivatives trader for Citibank and the CSFB. So I had that experience there in trading from a more of a bigger picture institutional side. And then for 13 years, I was with FXDD. The first 6 or 7 years, mainly focused on the risk management side of the business, controlling the risk within FXDD, or helping to control the risk. And then the last 5 or 6 years as a Forex analyst, became an author, or was an author of a book called Attacking Currency Trends. And you can find it, well, you have to actually go to Amazon.com, but you can find out about the book at attackingcurrencytrends.com. And since September of 2014, I've been the Director of Technical Analysis and Trader Education at forexlive.com. Another one of the great sites on the internet. Well, for you Forex traders, I'm going to start off a little bit light here, and to talk about one of my favorite shows on TV. It's called The Voice. My wife and I don't watch a lot of TV, but we do watch The Voice, and I understand that this is there's different voices around the world. So I think there's a voice in the UK. There may be one in Australia. I even saw, I think, The Voice in the Philippines. So some of you and most of you may be familiar with it, but the Voice is about a show where the panel here, if you will, that's Adam Levine. He's from Maroon 5. This is Pharrell. I'm being happy, da 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 da, happy. Christina Aguilera and Blake Shelton, the country music star here in the United States. But anyway, they sit in these big, huge red chairs. They turn their backs to performers, and the performers give what are called blind auditions. Okay, and the idea is that these professional musicians have the ability to look through what the person looks like, and just focus on their voices, and so they know what they are looking for. I mean, listening for in terms of the voices, and so they do it blindly, so as not to be influenced by movements or their performance, or how they look, or how attractive they are, or maybe even how unattractive they may be, because a lot of times that influences decisions that we make from what they see. Now, they are, and they just focus on the voice. Now, they are, obviously when you talk about music, when you talk about the sound coming out of someone's, mouth, it is it works on your hearing sense, And so that's it. That's the premise of their show. They know what they are looking for, and I often wonder if we could have The Voice, and instead of have the blind auditions, have the blind trader, and not focus on what we see per se, but what we might hear, or what we might, let's say, hear on TV, or hear in other forms of media. And so imagine for a second that you had two choices on how you were allowed to trade. And we're going to look at the first choice, and that is the voice choice, where we use our perceptions of mainly hearing. So let's just break it down into a very simple formula. Imagine that you closed all your charts. Okay, so you're not using your sense of sight. You're just using your sense of listening by opening up, say, a live squawk box, or by turning on your TV and listening to the CNBC or Bloomberg television. Now, I will allow you to watch the market prices, because kind of need to see the market prices, but we're not going to trade by seeing a chart. And my question to you at that point is, could you trade well with just using the voices, if you will, and in a blind audition type of way? For me personally, and perhaps for a lot of you, that would not be a good way to trade. I would not do well in that type of environment, just listening to what is, maybe even in the news, like I started off this morning, consumer confidence came down to 95.2. All right, well, it's weaker. Okay, what's the dollar going to do? Is it going to go, is it going to go higher, or going to go lower? Well, it should go lower. But that's what should happen. But we can't see, we could see the price action moving maybe in that direction, with the euro moving to the upside. We're trading at the highs right now, but that's all we know. That's all we know. We can't put a reference to it. We can't. We don't really know the full dimension, and so I would say no for me, most definitely. If that was one choice, I don't think I would do well. Now let's go the other way, and let's turn off the television. Let's turn off the squawk that's going to tell us that consumer confidence came in at 95.2, and let's just focus on, boom, the charts, the pictures, the voice of traders, if you will. And my question to you is the same question I had on the other one. Could you trade well? And I said yes, but that requires a little disclaimer as well. If you know what you're looking for. Yes, if you know what you're looking for. So instead of having the voice, where we have blind auditions and we're using our sense of hearing to determine good and bad, if you will, or yes and no, or are they going to move on or not? I think trading is more about not blind auditions, but the visual auditions, or the visual trader, and it's more in terms of not the voice, but the sight. The sight is the most important thing for me as a trader, and I think for you and for a vast majority of people as well. If you had a choice, it would be to look at the charts. The charts tell you a lot. Now, what do we know about our senses? Just kind of taking a step back, and we know that we have five. Humans have five common, or normal senses. We have the sense of sight. We have the sense of hearing. We talked about that already. We have the sense of taste. We have the sense of smell, and we have the sense of touch. Those are our five. The main senses that all people tend to have, luckily or hopefully have. There are some people who do not have these, and a lot of times, they make up. If someone's blind, they make it up, and their sense of hearing gets accentuated a little bit. But it would be difficult, admittedly, to be a trader, a blind trader, just listening to the squawk or listening to TV. Maybe they can do it. I don't know. It'd be an interesting study. But in trading, I like to think that if you can see something, what I call special in the charts, it can trigger all the other senses kind of in a non-literal type of way. And what do I mean by that? Well, I mean that if I see a great trade location, I can almost hear the market talking to me. I can, in a sense, taste victory on the trade. I can, smell a trend move a brewing, if you will, or I can feel like the market is going to take off to the upside or to the downside, and that all comes with my focus being on that chart. Like Adam and like Blake and Christina and Pharrell, they're focused on the voice. I am focused on the chart, and through that sense of seeing, I am able to hear, taste, smell, feel, probably the same way that the voice participant or the voice experts can hear, and they can almost see the performer. And see that, see something in their voice, see something in their passion toward their voice, toward their singing, and they can taste, that this one is going to be a great a winner. And they can smell victory, and they can also feel like this is the guy or girl that I want on my team. So it's, a lot of times when we use these senses, we almost have a you can almost in a literal way understand how it can influence the other senses that you may have, and kind of relate to it in a non-literal way. So it's kind of interesting in that respect. And so in reality, it is seeing something special that makes me believe, and makes my other senses start to kick in, even if it's in a non-literal type of way. So what helps me see and believe? And why does seeing make me believe? Okay, that's the next questions that we as traders have to ask, and I'm going to explain to you what makes me see and believe first. And so the answer to that is by applying simple or what the thing that helps me see and believe is applying simple technical tools. Because if we have a price chart and we don't apply a tool to it, a technical tool, and I'll get to them in just a second, we're kind of just looking at the price feed, aren't we? And we see momentum, yes, but we don't have a reference. And the reference is most important in becoming a more successful traders. Simple technical tools to a trader are the equivalent of the musical ear to a professional musician. You do need these tools, these trainings to be able to, and the training of the tools to be able to understand more about what you are seeing in that chart. And so it's important that it's not only that you see the chart, but you apply certain technical tools to that chart in order to make you understand fully all that's going on in that chart. So why does seeing make me believe is the next question. And because the simple answer is that when I see something and I use and apply a tool, see something in a chart and I apply a tool to it, and then I see the market react to that tool, if I see an energy that moves away from that technical tool, from those technical levels defined by the tools, that gives me a sense of belief that the tool is something that is working. The tool is something that I can rely on. The tool is something that I believe in. And so I believe what I see, much in the same way a trained musician believes what he or she can hear, even with their chair turned around, just looking out into a blank space or looking at the audience, and behind them they hear this voice that's resonating, and they start to hear what's going on, and they start to believe in what they see. And so I also believe that what I see is being seen by many smart traders from around the globe who are focused on the same charts, who are focused on the same technical levels, and are focused at the same exact time. If you use the right tools, if you use the tools that lots of people are using, if you see these tools in action and you see them on your chart, I take the next step and believe that other traders, other smart traders, other experienced traders out there, other experts in the field are actually seeing the same thing at the same time and reacting to it. And that causes the market to move. And that's a valuable thing. So just like our panel here on The Voice, with their backs turned, they're all listening, they're all experts, they all have their hand, look at how they all have their hands on the button, ready to push that button, because what they hear is something that they all want to believe in. And that is taking that connection, if you will, from using your sight and what you're seeing and the tools, and then believing in it, believing that other people in the world are seeing the same exact thing at the same exact time and are going to react to that by pushing their button in an actual sense to execute a trade, is going to allow that market to move away from that one way or the other. And that is a valuable piece of information that we as traders need to understand and believe in. If we don't believe in that, we are never, ever, ever going to sit on this panel as an expert. We are going to be left behind. We have to believe in what we see, and we have to react to it. Okay? Have to react to it. So before I get into the charts and actually show you what I mean, I have to make a disclaimer, and that is that most, or some, in fact, maybe even most traders ignore what they see. Now, the good news is that there is a lot of traders who still believe in what they see, and they actually overpower it. But a lot of traders don't see these things, or they choose to ignore them, or they just don't have the vision to kind of see the trees through the forest. Okay. And so why do they not believe? Why do they ignore these things? Why do these types of traders not participate in these levels that are so important, that allow you to be like these guys, these experts who are there? You have to be like these people right here, the experts. And so what stops people from being that expert? And I can characterize 5 types of traders who don't necessarily believe what they see, or simply can't see it. Okay? And try to think about yourself in this respect in an honest type of way, and see if you fit in one of these buckets, and then see if you can, maybe change or use that as a way to facilitate change in your trading if you're not trading well. Okay. Now, not to say that all traders do the same thing and are successful, but if you're not trading well and you're having problems, see if you fit in one of these buckets of traders that I'm going about to talk to you about. First of all, the ego trader. The ego trader always knows better. They know that believing in their convictions is how they will succeed. How many times have you gone and you said to someone, or maybe someone who's speaking, maybe quote unquote expert, or read somewhere that you have to have a conviction in your trading. You have to believe in what you're in your thought process. You have to have a huge ego, and in other words. that gets you in trouble is sometimes, being too positive in what you think, having this ego and saying that the euro's going to parity no matter what. I don't care what anyone says. That the ECB is engaging in quantitative easing, and the U.S. is talking about tightening policy in 2015. That means the euro is going to go lower. Well, the euro's at 109.78 now, just about to push to 110 level. 10 big figures away from that parity level. It got down to 105 and change down there at the bottom. We're not down at the parity level. So this is the ego type of trader who always thinks that they know better, and they're going to stick to the conviction that the euro is going to parity. Meanwhile, it goes up 500 pips from the low to the high, and they lose a lot of money and they disappear. So a lot of times the ego traders will make themselves blind to what they should be seeing, in the chart. All right, so are you an ego trader? The next type of trader who misses what they see is actually looking at a lot of things. And too many things, and they're called the complicated traders, and they have so many things on their charts that they miss what they should really be looking for. They might have the RSI, the stochastic, the CCI down at the bottom. Then they have moving averages and Ichimoku clouds and Gann retracements and Fibonacci retracements and all sorts of things on their charts. And they're not able to see the trees of the forest. They just see a big, huge forest of things out there, and it clouds their judgment. It clouds it complicates things to the point where they don't see what's most important. They don't pick up on the things that really the rest of the world is looking at. Because who in their right mind looks at all this stuff and makes a judgment on all this stuff right here as to whether you go long or you go short? Very, very few. You don't need so many things. In other words, you could get along just fine by just having this one little line right here where you bought against that level, as opposed to all this other stuff. So complicated traders tend to miss the boat. They tend to get themselves they miss seeing what is most important, and these types of traders can get themselves in trouble and not see what they really should see at the right time. And the third types of traders are proprietary or black box traders. And these types of traders have their own little secret algorithm that will vault them ahead of the market. Now, believe me, all these 5 types of traders that I'm going to outline here, I have been. Okay, so don't get me wrong in that. There was points in my life where I was building my own proprietary black boxes with formulas that look like this, and with buy and sell decisions, and then trailing stops, and with all these sorts of nested loops on tops of loops, and if statements and whatever. It was all very complicated, and I was very proud of the fact that I was going to be able to tell the market which way the market should go. Well, I found that didn't necessarily work, and for people out there who buy black boxes, you may find the same thing. Otherwise, everyone would have them and everyone would make a ton of money. But it's not that simple, folks. It's not. Trading is not about about having the same thing happen at the same price over and over and over again. And it's certainly not about being proprietary in what you do and secretive and acting alone. Trading is about being with the crowd, being with the smart crowd, the smart traders who see the levels that are most important. And if you put yourself in a bucket, in a little bucket that has just you and you alone, you're not going to be able to push the market around, because I don't know about you, but I have never, ever, ever, ever done a trade where I've moved the euro or any currency pair a pip. Okay, I may buy it and it may go up a pip, but it wasn't me that caused the price to go up. Okay, I can guarantee you that it wasn't my amount of trade that moved the market. All right, it takes the big traders can move the market, okay? The big boys, if you will. You and I and the rest of the people cannot move the market. So why try to put, again, it kind of moves back to the ego thing. Why put your ego in the way, thinking that your proprietary system is going to be able to move the market? It's not. So trade with the crowd. Proprietary traders miss the boat. They don't see the things that the smart traders are looking at. Try not to become a proprietary black box trader. Doesn't work. Scare traders. Now, scare traders actually see trades, okay? But they're just too darn scared to pull the trigger. And I know there's a lot of people out there, especially when you're beginning, and you have this fear of losing money. It comes from fear. You're too scared. You're too scared to trade because you fear that the market's going to go the other way as soon as you do the trade. And a lot of times, Sod's law said that does happen. But what you have to understand is that you have to so you have to believe in what you see. And so scare traders are at the point where they can see things, but they don't necessarily believe in what they see. And so they don't trade what they see, and so they're afraid to pull the trigger. And there's different types of traders who don't trade and trade with the smart money. And finally, there are the story traders. Now, the story traders are the ones that let the most recent story or stories cloud their judgment of what they see. Now, don't get me wrong. The consumer confidence and the Richmond Fed manufacturing index just came out, and it's a story. It tells you a story about the U.S. economy, and we had data that came out yesterday, weaker, and all those kind of move in a way into that create a story that say, well, the dollar is getting weaker against the euro. If you don't focus on the euro side, that's the way, and so you see the euro move to the upside. Now, so the story is important. It's important to understand the story, but to focus everything on the story is not the best type of way to trade as well, because the story doesn't do one important thing. It doesn't tell you where you're wrong, okay? And that story is ever changing. If consumer confidence came out stronger than expected here today, then we'd see the story change. We'd be talking about how the U.S. is going to, the Fed is going to tighten in, earlier rather than later. And so that story is always changing. But the thing that the story doesn't do is it doesn't tell you where you're wrong or why you're wrong, and it doesn't define your risk, because it's forever changing. So people who focus too much on the story, too much on the fundamentals, if you will, tend to not see what the charts are telling them, what the levels, what the smart traders are looking at in their charts. And so those types of traders get themselves in trouble and do not trade what they see. The fact is, folks, is that if traders decluttered their trading, if they were able to free their minds up of all the extra stuff, if they were able to get rid of things like black boxes that make trading a systematic formula every time, it just doesn't trade that way. I think that and instead simplified their trading by focusing on what they're able to see and use tools that help define and limit their risk, we'd all be better off. We'd be better off as a trader. We'd be seeing the market. We'd be, like the voice people, they'd be hearing the voice. We are seeing the market. We'd be able to see things a little bit better. And smart traders, that point about defining risk and limiting risk, smart traders will always sacrifice a small loss where they define and limit their risk or their loss for the potential to make something more than the potential loss. And so I'm saying that in a regulatory proper way of saying it, that if you can risk a little and try to make more than a little, whatever that little is, it's a lot better if you risk a small amount, and then you have the potential to make a multiple of what that small amount is. But smart traders will always look to sacrifice a small loss, even if it's against the story, even if it's it runs against the tide, if you will, of some other things, maybe even their black box. They will tend to do better and and be able to make a little bit more, make more money. So focusing on what you see requires a lot of practice, 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 and it requires what I call making it a habit. And what is a habit? Creating a habit involves three-step process. One is you take a cue, you execute a routine, and then you have a reward. And this is what is called the habit loop. And as we as traders have to think about creating habits in our trading by seeing things, by taking a cue from what we see, then executing a routine from what we see, and then getting a reward from doing that routine. Now, before I get into the charts, which are finally coming up, but this has been the prelude to what when we start to get into the charts. We talked about bad habits, bad types of traders, and now we're talking about creating good habits by taking a cue, routine, and reward. Before I get into the charts, I want to talk a little bit about the idea of the reward. And here it says that. It assumes, or people are probably assuming that the reward in trading is a profit. That the reward is a profit. You see something in your chart, you execute a trade, buy or sell, and you get a reward. That is half true. Okay. The half true is that sometimes that we all know that the market can go your favor. So you may be picking these points where to trade. By taking a cue and doing the routine, and either buying or selling, the market goes your way, and you make a profit on the trade. But is there a reward in a loss? Is there a reward in a loss? And my answer to you in that is that yes, there is a reward in your loss if you define and limit your risk. If you define and limit your risk, that is a reward to you as a trader, because we as traders know that we are not going to win on every trade, that we are going to have losing trades along the way. But if we lose or risk a little with the potential to make more than a little when we win, we don't have to be right a lot of times in order to even to make more money, to be rewarded in the aggregate in our account by having our account balance go to the upside. Traders who don't define and limit their risk do not have this reward of having a limited loss on their trades, and they may not define and limit their risk because they're trading, with things like momentum, or trading on the story, and they don't see the levels in their charts, and so they don't know. And so we as a trader, if we use our sights and we use our what we see, we are able to get a cue from that. We're able to develop a routine from that, and then we're able to reap the benefits of reward, even if that reward is a loss. Even if the reward is a loss. And that's that's an important thing to believe in, is that even your losses can be rewards at times. Ron's asked the question, seems like pretty fine line between having confidence in your trading skills and trader one, the ego trader. Let me speak a little bit to that before we get into the examples as well. You want to, the ego trader that I guess I speak of is someone who probably bases their decision not on what they necessarily see. So maybe that's a little bit of a distinction between someone who bases a decision on what they see and confident in what they see, and the true ego trader. Also, an ego trader will ignore the risks of the trade. They'll more, in the ego trader that I'm talking about, they will be more inclined to know that they're right and be confident, be confident to the point of being stubborn about their position and take large losses because they know that euro is going to parity. Okay, maybe that's the best distinction of an ego trader and someone who's confident about their trading because they see something. Is that we as traders who see something and develop this habit understand that it is really the defining risk and limiting risk that is that curtails that keeps our ego in check. And if we're able to keep our ego in check by understanding that we are going to lose on trades that we're willing to accept that loss, and we're willing to limit that loss as well because it's smart money management, it's smart business logic, then we're better off. An ego trader will not. They'll be confident about their trades, and that's good. But they will, and their convictions, but they won't. They won't make smart decisions as far as their loss goes. So maybe that helps you. Do okay. Okay, let's take a look at some charts and we get some questions at the end. All right, here's the sterling versus U.S. dollar. This is an hourly chart, and this is I want to create a little bit of a habit about what taking a cue, developing a routine, and doing rewards. So I'm going to ask the same question: What do you see? What do you see in this chart? Now, I put my tools that I use are simple trend lines, and the trend line can be a horizontal line as well. This is just a ceiling or a floor. It could become a ceiling or a floor. So in this chart right here, we have a nice little trend line, connects 1, 2, 3 different points. We have a nice little ceiling area here where we have 2 points right here, and we have 1, 2 points right there. And so we have this convergence, if you will, of two areas here. And we saw the market move to the upside above this area right here into the channel. So the market's moving higher. And then we get down and we come down and we move back below that level, find support against this level. And at this area right here, the question becomes, what do we see? What do we see right here as a trader? Is this an area where we can define and limit our loss? And at this point right here, where we have this resistance up here and we have this support from the trend line, and the market's testing these areas right through here, a number of different hours going into the Asian session, we have two ways that this market can go, don't we? Either it's going to go to the upside or to the downside. And if you were to lean against the top side right here because the market breaks below the trend line, where might you define and limit your risk on a break, on a final test of this line right here, a breakdown below this trend line? Where would you define and limit your risk? And the answer is simply above this level right here. This is what you see, and this is a routine that you have to go through. What do I see? What do I see right here? Well, I see the trend line, and I see another trend, the ceiling right here. I see the market failing above that ceiling. I see the market moving back below and testing the trend line. I see the market coming up and testing the ceiling again. So if you can get in the habit of just doing this, what is the cue? I see resistance. What is the routine? I can either sell or buy. Which way is the market telling me to go when the market breaks back below this trend line? It's telling me to sell. Where is my stop above that line? What am I risking? This amount on the trade. What is my potential gain? I don't know at the time, okay? We don't know what the potential is. The only thing that we know is that our risk can be defined and limited right here. Ignore where the market went and understand that all this is white here, okay? All this is white. It's not there. But what we do know, and the big step, and what makes it, we believe that this is what we see is going to be good for our trading, is that our risk can be defined and limited right here. Right here. That's it. Put your finger in the distance between here, and that's how much you're going to risk on the trade. Do you have a chance to make more than that on the trade? Do you have reasons to do this trade from what you see? And the answer is yes and yes. And so if you're going to trade on this day, this is the area to trade. This is the area to trade. That's another thing. If you have one place to trade on this day, why wouldn't it be at this area? And that gets you over the hump for those traders who are scared traders to think, well, okay, I can define my risk and I can limit my risk. If I'm going to trade, if I'm going to call myself a trader, this is the area that I want to trade. And the market goes down off of that. And of course, it moves in your favor. If I was wrong here, and of course I'm going to show you, winning trades or whatever. But the point is that at all times, I'm willing to lose an amount, and that's going to be a reward to me because my loss is going to be defined and limited. And I'm not going to look at it as a loss. I'm going to look at it as a reward. It's a small reward. It's a negative in my account balance, but we know that as traders, we accept that we are going to have losses at times. What I want to do is define and limit that loss. So what do you see? I see resistance. I see a couple reasons to sell. And can I define and limit my risk? And the answer is yes. The reward pays for the risk that I took on that trade. All right, let's move on a little further in the trade and follow. Here's where we're at right here before, and now the market's come down. Okay, the market's moved to the downside, and at this area right here, what do we see? Well, again, I just draw a trend line connecting most recent lows, and I see the market finding support against that low right there. I see, this trend line really did, this trend line defined itself right here by finding support against this low right here, and you can draw that trend line right here, and then the market goes up and we come back down into that trend line. So, what else do we have in here? I add another tool here. This is a 38.2% retracement level. So if you were to come in and see this, forget what we're seeing right here. Forget that the market moves higher. But if you're coming and see this formation, see these trend lines, see the 38.2% retracement, see the reaction to the upside and then move back down to the 38.2% retracement. What would you infer at this point right here? What would you infer at this point right here when the market moves back above that level right there? You would infer that the price, that you can define your risk and limit your risk against this level and the market can go higher. Now, some of you are probably asking, well, I went long right here when the market broke above the trend line, the same thing that we did right here, and I lost on that trade. Yeah, you lost on the trade. That is defining and limiting your risk. Sometimes it takes a little luck. Sometimes they have this final move to the downside right here that causes you to get out of that trade. But my question back at you is that the market did, you bought right here. The market went up a little bit. You thought you were in a winning trade, and then you stopped yourself out right here, maybe below that line, or maybe you kept it open until the market, until this point right here, and it never went below that point. Or maybe you got yourself back into the trade right here when the market failed to go below this area right here, and the market moved higher. So again, the idea is to find different reasons. Take a cue from what you see and look to define and limit your risk. And if you're able to do that, you start to believe in what you see. You start to hear the market moving back to the upside. You start to taste the victory of when you start to feel that the market it has buyers down there and they're not sellers and they're turning around to the buying. And those are the types of feelings that you want to make you confident in a trade that start to move it higher. So this is another area. Again, if you were to trade, if you were looking at this chart and drawing these simple lines that everyone in the world can see and putting a Fibonacci retracement from a low to a high and measuring the 38.2% retracement and having all these things converge together at this point, this is where you want to be involved in trading. This is you throw out the stories, you throw out everything else, you throw out the fact, the momentum, and you just start to believe in what you see, and you'll be more successful. This is just a continuation of the trade right here. So this is our last trade right through here. The market comes up, and what do we do in this area right here? We define risk and limit risk against the 100-bar moving average. That's the blue line in this chart, folks. The 100-bar moving average, the 200-bar moving average is the green line in the chart. Market goes up, comes back down. We have the 38.2 to 50% retracement of this move to the upside. People thought, some people criticize criticize me the use of this. They can see this. They can see the big, huge move to the upside and the move to the downside right here. And but they don't understand this dynamic of using a Fibonacci within this little trend. This is a trend type move. It's a fast and directional move. When the market comes down, we want to see the price try to find support in the 38.2 to 50% retracement, because we know that markets trend to the upside. They trend to the upside. They come down a little bit and they trend. They continue. Either they're going to continue the trend or they're going to fail and they're going to start to move to the downside. So the fact that the market came down to the 100-bar moving average, came down in between the 38.2 to 50% retracement level, and then started to find a base against that level, gave traders confidence to enter in here. Where's risk? Probably below the 50% retracement level through here to get the market to move to the upside and move higher. I'm not sure. I'm pretty sure that in fact, I think that this is one of those days in last week's trading where the market didn't necessarily have huge economic data come out. It was just one of these slow grinds, and a lot of times these grinds to the upside start from key levels where the market couldn't go lower. The market can go lower. Traders see this, and the smart traders are in here, and the other traders who don't see this, they're sitting there selling against this old high right here. And what does the market do? It comes up to that level and then breaks to that level and just continues its trend to the upside. Do I use multiple time frames? Yes. I'll show a little bit of example later on, but for simplicity in this report, this presentation, I just kind of kept to the hourly chart. But imagine this, that there was something on the daily chart or the 5-minute chart. I like to use those two types of charts in my analysis. And imagine if there was a technical level at this area or this area right here that would give you more confidence there. Then that is going to allow you to even give you more confidence in what you do and allow you to even further define and limit your risk. So if you can find, I don't look at longer term, like a daily chart, an hourly chart, or 5-minute chart as a longer term trade, a swing trade, a shorter term intraday trade. I look at them as proxies for those types of traders. So longer term traders, or people should pay attention to where the 100-day moving average is on the pound versus US dollar. And if you know where that level is, you have a better chance to lean against that level, and it could have an influence on your hourly chart as well. So good question. Continuing on here, we had our ceiling right here. This is our old ceiling. This is kind of a head and shoulders right here, and kind of broke through that level right there. But we had this old ceiling right here. It became a no-brainer through here when the market started to move above that level. And again, it wasn't on economic data. It was just or key economic data. It was just a grind to the upside, a holding of the 100-bar moving average, and moving above the old highs. This whole ceiling. If you see this level, this is a move to the upside. A lot of the things that we've done so far have been on retracements, and they're often the easier trade when you come down and you see a trend type move or a trend type move, and you see a tracement when it comes to a level right here. This is a breakout move. A little harder trade to do, but it's still a risk defining move. We saw the market move up to this yellow area right here. We had the ceiling. We saw the market move through that level. At this point right here, where the market goes up and comes back down, you can bet if you just came in, you just woke up and you turned on your screen and you see the price moving above this level, the only trade that you have right here, or one of the trades that you have, is that I can see this. What do I see right here? I see the break above this level. I see the retracement down. I see support against this level. Where can my risk be? Below that level, I'm going to buy right here. I'm going to risk this amount on the trade, and I have the potential to make something. I don't know what I'm going to make again because I don't see it, but the market does move to the upside. All right. Okay, I'll get to that. Yeah, okay. In that example, is a downtrend for a few days. Why do you think it will go up? Well, here we, from this point right here, I assume. So we had the downtrend for a few days. We came down to where the 38.2% retracement was of this move. So here's here's a big move. Here we correct down to 38.2. We hold the trend line right here, and the market and the market it is bearish below the 100-bar moving average in a certain respect, but it is also bullish against 38.2 against this trend line. So if you were to sell against the 100-bar moving average, and you could do that, you can sell against 100 and think that we're going down through here. In which case you're wrong. You where would you get out? You would get out right here. So if you sold right here against 100, thinking that the market's going to go lower, where would you get out if the market moved above the 100-bar moving average? If you bought right here, you would be the opposite. So this is so you're right. I mean and I'm not saying again what I'm looking at is. Well, if I were to rank it myself, I would look back here, see the range to the upside. I see the 38.2, and although it's below the 100-bar moving average, we still are above the 200-hour moving average, and we're holding the 38.2 and above the trend line. So those things kind of let you go in that direction. All right. A couple. Well, let me get to the final thing here in today's trade in the pound versus U.S. dollar, because this actually looks at the two different time periods. And one is that the market in today we had the GDP come out, and the market. We had this trend line here, and we found support against that level, and then the market fell below that trend line in the GDP data. And we came down to this level right here, which was near this trend line right here, but also near the and near this consolidation area right here. So if you bought right here, you're stopping yourself out when the market goes lower, and you may lose this whole amount because the market moved fairly quickly to the downside. But at this point right here, if 151.75, why was that level so important? Well, off the hourly chart, you can see that we had the consolidation here where the market just barely moved in this very narrow trading range on Monday or Friday into Monday's trade. And we're close to this trend line, but it's not quite on it, but it's close enough to it. But if you go to the daily chart and you take a look at where the low came in here today, and you see this blue line right here, that's a 100-day moving average. You see this trend line right here connecting these 2 points, or these 3 points right here, because we had 1, 2, and we had 3. That low that we had today came in at 151.75. So the market found support by a combination of things. One, off the daily chart, the 100-day moving average, and this trend line, and two, off of the hourly chart. All right. I just want to make you aware at Forex Live, we have a new education site where we're putting some neat videos up there that I think that you might be interested in seeing. There's a new video about habits there. If you haven't seen it, go to our website at forexlive.com, click on more, click on education, and we'd love for you to sign up. That allows you to also be on our mailing list as well. So if we have bullish, thanks, Juan, you're the best. Okay, any other questions here before I have to hang up here? Do you draw on one chart with multiple furnishings, or use 3 different charts? That's a good question. I use 3 different charts in my analysis. I have a daily chart, I actually starting to look more at the 4-hour chart, especially in non-trending markets, an hourly chart, and a 5-minute chart. And so I will go through and I'll draw my lines, put my Fibonacci retracements on the charts for each of them, and move from there. So I'm constantly looking for those opportunities that might present themselves, and for those multiple levels. So it's about creating the habit, folks. It's about moving through those charts in a methodical way. I don't suggest going around changing a lot of I don't suggest going and trading a lot of different currency pairs. I kind of have to have a lot of charts available, but I look at the charts in a very simplistic and very consistent type of way, and suggest that you do that as well. And then there are other times when you have to clean up your charts, like this trend line right here. It doesn't really, it had 1, 2, 3 different points. It doesn't really have a relevance anymore, so you take it out. So it keeps your charts clean. We are moving up to the 109.97 level here. My job obviously at Forex Live is to educate, not only is to educate you and to I trade usually the euro, okay, and then the major currency pairs. I rarely go into the cross currency pairs. It's just, our focus is to make sure that we get news out to you and stuff out to you. So a lot of times, imagine if you were sitting there writing a blog while you're trading, you wouldn't be doing the smart thing in that respect. A lot of different times. So a lot of times I'm looking at the charts, but mainly focus on the euro, then the yen. I like the Aussie versus US dollar, and I also look for markets that are tending to trend. I like trending markets. They tend to follow the path, and they trade well technically. So that's what I would suggest that you do. Okay, I gotta go. Take care, everybody. Thank you very much to the people at Forex Live. Bye bye now. If you want this, you can come to our Greg at FX forexlive.com.